We're picking up a little steam as we just showed you in the market, green across the board. So we'll see how this day progresses. All right, calls of the day. Netflix. Target goes to 510 from 480. Reiterated overweight JPM. We do that stock because I wanted to hear your take on Disney. It's our way of segueing to you because we didn't get to hear from you after the earnings report. And a darn good day for those shares.
Yeah, it was
finally.
A good day. I know. But you know how you asked me like the other day, oh, is Intel finally in the clear? And I said I was kind of meh for a while, and then finally was. That's how I am with Disney now. There's still a lot of wood to chop here. But I think our takeaway from what was the most interesting on the earnings call was the granularity, where they're like breaking out ESPN. They provided a 25-page explanation of earnings and their strategy, and we think that really probably is influenced by Nelson Peltz. So I think of all the wins from this quarter, not resting on the laurels of being like, oh, we're Disney, we're just going to tell you how it's doing and we're not going to do the hard work of breaking it out. I think the big win was them waking up and saying we really need to tell the shareholders with granularity what's going on. So, you know, our thesis is intact, which is that the theme parks are trading at such a low price, you know, as if the whole company is based just on the theme parks, as if everything else has no value. And the reality is earnings growth should be decent coming up. This is a perfect segue. So here's what expectations for Disney's earnings growth are, right? It's 19% in 24, 21% in 25, 21% in 26, because the base is so low.
And you assume those are accurate.
Right, but you know what? What if they're cut in half? If they're cut in half, you still have a stock that's trading really cheap, where there's no expectations, nobody likes it, it's a hate fest. It keeps reminding us over and over of this time exactly last year when we were defending Meta, and everyone wanted to hate Meta and dismiss it and think nothing was actually going to come and the cost cuts weren't going to work. So we're like, you know what? It's bottomed out, it's cheap, it's got earnings growth. If they don't make it, the expectations are so low, the margin of safety, sorry to use the word so much, is so huge. Like, I'm really comfortable sitting here for another year.
All right. Are you comfortable with Schwab,
yes,
which is also back to you, named top pick today at Deutsche? The target gets cut by $1, right, from 67 to 66. We think Schwab shares will continue to grind higher into year end. Right.
So totally in line with that. And I think this one's really interesting, where Deutsche Bank has Schwab at $5.29 of earnings next year, in 2025. So it's trading at 10 times 2025 expectations, 14 times next year. That whole cash sorting that happened right in the wake of SVB, where people took all their money out of their 0% money market funds and put it into the high yield money market funds, and that hurt Schwab. That is completely tamed, completely chilled out. Here's another one. You know what earnings growth is expected to be for 24? 21%. 2025 is expected to be 28%. The stock's trading at 10 or 14 times. Like, I'd much rather that math working in my favor than 10 or 11% earnings and 30 times multiple.
What about XPO?
Oh
Top pick at JPM.
I'm in the hot seat here.
Rating overweight, target goes to 88. You own that one.
We own that one. So we trimmed this a little while ago, a couple weeks ago at 75. So they're less than truckload. And so while there might, if we look at peers, if we look at FedEx, if we look at UPS and what kind of that data is looking like, there could be pressure for less than truckload. But in the case of XPO, we think they more than offset the LTL, less than truckload demand, with volume gain. And they're taking share from Yellow as that's sorting out. So here you have a stock that's up 143%. The free cash flow yield, because this is in our growth portfolio, so we look at free cash flow yield, is only 3%. This is much more likely to be a source of funds for us than an ad.
Okay. Weiss, you used to own XPO. You bought more GXO.
Yeah, so I made a mistake selling XPO. Management...
Hold on, what? Can you say that again?
I made a mistake selling XPO.
Wait.
I bought it. I made money on it. My concerns on it were the freight environment. Obviously, they benefit from Yellow Freight, but management is excellent. I mean, Brad Jacobs, who founded XPO, founded GXO, just did a phenomenal job grooming, training, and bringing along these execs in both companies. I added to GXO. They reported earlier this week, and it was a phenomenal quarter. Keep in mind that 95% of the 3PL network of warehouses has no automation whatsoever. GXO is 50% automated. They continue to pick up tremendous market share. The pipeline continues to grow. They beat this quarter. They narrowed the guidance for the next quarter to the upside. So I think that the stock is compelling here. I also added to Goldman. Goldman, I much prefer to Schwab. The reason being is Schwab management's fine, but I've got to know Goldman management pretty well. I think David Solomon is doing a tremendous job. went in some areas that they shouldn't have gone into and was very quick to say, hey, let's turn around, those weren't right for us. But more importantly, they're spring-loaded for just amazing earnings growth once the markets open. The pipeline that they have, that Morgan Stanley has, that all the investment banks have, that Schwab doesn't have, is just incredible.
Sure, but
pipeline of high margin business.
Comparing the two is like comparing apples and oranges, though.
Well, they're both essentially. They are.
I'm not
You're
saying
right.
one.
It's like
You're right.
I'm not saying one good versus one
right.
bad. I'm
It's
saying
very
different.
different.
But they're both
company
in
versus
right.
Totally
But they're
different
both
company.
financial services companies, right? That's undeniable. I prefer the one that has a huge pipeline of high margin business rather than the one that is just in the spotlight, right? Like all these others are, for seeing how many free services they have.
You think Goldman's not in the spotlight more than Schwab?
You didn't listen to my entire sentence, did you? Did you?
For the
Schwab
services, right.
Schwab is selling ETFs, no commission. Schwab is selling, trading, no commission. Goldman is selling IPOs and merger advice, high commission. That's the difference.
All right.
Schwab benefits from balances, just like Goldman does.
And
but I'm not saying Schwab's a
It's
bad
not all
company.
no
I'm saying
commission.
there's much more juice in a Goldman or a Morgan Stanley than there is in a
And I would
Schwab.
argue there's much more consistency and predictability in a Schwab.